The top business stories live from the Sky News City studio. The US markets await earnings from tech giants Microsoft and Alphabet. A jump in Jaguar Land Rover sales puts parent company Tata Motors back in the black. Plus, the iconic NME returns to print as a global magazine. Good afternoon. This is Business Live with me, Ian King. It's a big evening for company earnings in the United States. The tech giants Alphabet and Microsoft will be posting their results in the next few hours. I've been speaking to Sophie Lund-Yates, equity analyst at Hargreaves Lansdown, about what to expect. I began by asking her whether the adverse reaction to Netflix and Tesla's results last week had any read across to the tech mega caps reporting this week.
Unfortunately, yes, I think that there is quite a significant read across, particularly when we look at Netflix. For all intents and purposes, they performed incredibly well. But really, we're in a stage now, unfortunately, where valuations have reached a point where the way I'm looking at it is that good is no longer good enough. And even a small bump or what might be perceived as a small slight is actually being taken quite significantly by the market. And essentially all we're seeing is that nerves are incredibly high, and that will make positive share price moves a lot harder to come by with the big names coming in the next couple of weeks.
Now, obviously, Microsoft and Alphabet kick us off this evening. What are you looking for?
So a few things. I know we're probably all bored of hearing about it by now, but I will be looking at any commentary around AI, particularly where Microsoft is concerned. So Microsoft, compared to a lot of the big names, is probably one of the better placed in terms of being able to capitalize on AI revenues. Kind of got quite a few plug and play options there. So any kind of more granular detail on what that might look like will go down very well indeed. And then also with both Alphabet and Microsoft, I'll be looking at the outlook statement. Always important, but while consumer sentiment and business sentiment is so wobbly at the moment, anything they have to say as well about what that might be looking like will be really important too.
There's been a lot of speculation that cloud revenues at both Alphabet and Microsoft are coming under pressure. Is that something that's front and foremost with investors right now, given what you've been saying about AI?
Yes, absolutely. That is going to be front of mind. I think what's really integral here and something that's really important to look at is the fact that when we look at the US, consumer spending is starting to unwind. It's down about 6%. That is going to be having an effect on businesses, and they are nervous about this profile. So that, for me, is going to be a really important thing to monitor.
I get the sense that Microsoft has left, certainly Alphabet, in the dust when it comes to cloud. Is that correct to say that?
It's certainly true that Google Cloud is much smaller than a lot of its rivals. So I think in that sense, yes. You could phrase it that way, but I do actually also think that in a lot of senses that sort of potentially makes Alphabet a little bit more exciting, because as much as it's not guaranteed, the runway for growth and the potential room for expansion is really quite exciting. But I would say, yes, that Microsoft has really had a strong hand on the market share in this area, and if it gets its cards right, plays those right, then I do think that that could continue to be the status quo. But I do think there's great opportunity on both sides.
Obviously, digital advertising is the meat and drink of Alphabet's business. There's been a lot of commentary in recent days suggesting that there may be a slowdown in some sectors. I mean, Martin Sorrell's S4 Capital in this country only yesterday. What do you think we're going to hear from Alphabet on that front tonight?
This is the million-dollar or rather billion-dollar question, to be honest with you. I am currently feeling relatively bullish in that I'm not saying that the outlook statement is going to shoot the lights out there, but I do think that there's still a lot of resilience left. The fact of the matter is that Google is the ultimate place to be if you are trying to advertise something. That is not something that all of the other advertising revenue companies can say. We've seen Meta struggle at a higher degree than Google or Alphabet struggled, for example. So I do think there's going to be some commentary around potentially some softening, but the degree to that I don't think is going to be particularly alarming.
And then you mentioned Meta. Obviously, we hear from them tomorrow evening. The share price has had a really, really great recovery in recent months. Does that mean it's priced for perfection now?
There's certainly a great deal of pressure riding on Meta's shoulders. And I think a large reason, a large thing that investors are really looking for is continued execution of this kind of pared back strategy that Mark Zuckerberg has promised. You know, he's kind of toned down the metaverse talk a little bit. He's rechanneling money into the traditional business, and that is what investors want. He had a lot of the right ideas, but there wasn't a great deal of idea in terms of how this was going to be executed. So long as he doesn't stick down, go down that path again and confuse everybody and overpromise things he can't yet deliver, I think that there is a chance that Meta still has a little bit of further room for growth. But as you were pointing out, that valuation is incredibly frothy at this point, and I do think there's a risk of ups and downs.
Now, Sky News has learned that the London-based business newspaper City AM is preparing to go into administration after a month-long search for a buyer failed to produce a deal. Our City editor Mark Kleiman broke the story a little earlier this afternoon.
I understand that City AM is close to calling in administrators from the accountancy firm BDO, which could happen in the coming days. Now, City AM is a business-focused free sheet title, which won't be that familiar to our viewers outside London and the home counties because that's where it's distributed. But it's become a fixture of the London newspaper scene over the last nearly 18 years since it was first published, but it's been hit hard by two factors, really. The first is the decline in footfall since the onset of the pandemic. City AM has a largely commuter-based readership, people commuting into London to work. And the other thing that's counted against it in recent times has been the soaring cost of newsprint. Now, there is some potential light at the end of the tunnel. I understand that City AM remains in discussions with at least one prospective buyer. That could take place through a process called a pre-pack administration, where an administrator is appointed and then a buyer immediately takes control of some of the company's assets. But we'll have to wait and see over the coming days whether that ensues. As I say, a fixture of the London newspaper scene over the last nearly 20 years, about to go into administration potentially.
And obviously, we wish the team there all the very best. A lot of good business journalists have come out of City AM over the years. Now, the groceries giant Unilever today became the latest player in the sector to declare that food inflation has peaked. But the company behind Marmite, Magnum Ice Cream, Dove Soap and Hellmann's Mayonnaise said it was still having to raise its prices to reflect higher costs of commodities such as oil and grain. Well, Unilever was reporting a net profit of €3.9 billion for the first 6 months of the year. That was up 20.7% on the same period last year. That came on the back of a 9.1% rise in underlying sales growth during the period, all of which came from rising prices. Unilever's sales volumes fell by 0.2%. The figures, news of which sent the shares up by more than 4%, are the first reported under Unilever's new chief executive, Hein Schumacher. The International Monetary Fund has confirmed its predictions for the UK economy for this year, forecasting percent growth of 0.4% for 2023. The IMF said cheaper energy and calmer financial markets had led to an improved outlook, with 1% growth expected next year. Tata Motors has credited a strong performance at its Jaguar Land Rover arm after it reported better quarterly profits than expected. The Indian company reported a net profit of 32 billion rupees, that's around £304 million for the 3 months to the end of June. That compared with a loss of 50 billion rupees in the same period last year. Well, Tata, which last week announced plans to build a £4 billion electric vehicle battery plant here in the UK, said this was mainly due to strong sales at JLR during the period. JLR achieved free cash flow of £451 million during the 3 months, which was a record performance for the quarter. The owner of the Daily Mirror, Daily Express and Daily Star has blamed a change by Facebook in the way that it distributes news for a drop in half-year profits. Reach, which also owns regional titles such as the Manchester Evening News, reported an operating profit of £36.1 million for the 26 weeks to the 25th of June. That was down 24% on the same period last year. Well, Reach blamed a 16% fall in digital revenues, which it said reflected a material impact from reduced page views following Facebook's deprioritisation of news content. Its print advertising revenues were also down 18%. That was due mainly to tough comparisons with last year, when there was high government spending on public health messaging. Now, the iconic music publication NME is returning to print after 5 years of online-only sales. It's relaunching with a bi-monthly magazine featuring music, TV, film and gaming. Well, joining me now is the Chief Operating and Commercial Officer of NME Networks, Holly Bishop. Holly, good to see you this afternoon. What's behind this decision?
Well, NME has an incredible print legacy. the biggest names across music and pop culture have graced our cover for the last 7 decades. And as a brand, we believe it's vital to provide that omni-channel experience to our consumers. And from a digital standpoint, we are reaching the biggest audience ever across our .com proposition and social channels. And from a digital standpoint, we've already made some great strides with bringing back the NME Awards in 2020, and most recently with the launch of NME Screens, our flagship film franchise. And really, print delivers an experiential quality that can't really be likened to many other mediums. And from a fan perspective, an artist, it creates an immediate and tangible connection and value that is unrivaled. And for us, that's really, really important and is a key driver to moving us back into that print space.
So how big will the initial print run be?
So we are opting for a very non-traditional approach to a traditional medium. We're actually moving away from a traditional newsstand distribution and favouring a limited, limited high hype drop strategy that you would see more predominantly in the fashion space. So you see it with the landing of new trainers. No one quite knows when they're going to land or where they're going to land, but that hype and that build-up and buzz is something that we're going for with our print product. So very, very different to any other approach that any publication has taken to print. But we believe that in a world where you can get your hands on any product at any time, there is value in creating scarcity around something and creating something that people have to work hard for, and landing it for the super fans, really, that will work hard to get their hands on a product. And
will the content differ from what you put up online? Will it be unique to the print edition?
So you can expect to see a mix of the best of our online content, so representing all of those verticals that you mentioned, music, obviously, film, TV, gaming, so the best of those verticals, but also there will be some print exclusives in there too. I don't want to reveal too much, but yeah, there will be some content reserved exclusively for print. And in terms of the cover itself, back in May, we launched a brand new cover strategy, which saw us double down on our new music efforts. And so while the inside of the magazine will feature all of the big names that you'd expect to see, on the cover itself, we'll exclusively reserve that space for emerging talent.
And how rapidly will this particular product have to turn a profit?
So in terms of profit making, obviously keeping the numbers limited and pushing that scarcity in the model, it's not about driving profit out of this product on day one. We're building this ecosystem around our consumers that ultimately creates a bigger value. And NME is in a fortunate position that it's doing very well as a business and we have diverse revenue streams, which means that with this product in particular, we can really focus on creating a product that is for our super fans and doesn't necessarily have to be about trying to reach the masses and generate huge sums of cash on day one.
What sort of reaction have you had from the music industry?
Really positive, actually. So, the sentiment's been great. I think people are just excited to see NME back and actually in a totally different format to that which it's previously been published in. I mean, it's changed shape and form many times over the years, and this new premium bi-monthly edition will look very different, but we're excited for fans to get their hands on it.
Excellent. Well, best of luck with it, Holly. Good to see you again this afternoon.
And you. Thanks, Ian.
Now, it's been one of the biggest weeks for cinema in recent years, with the joint release of Barbie and Oppenheimer bringing in more than £30 million to UK theatres since Friday. It comes at an interesting time for the film world, with an actors and writers strike in Hollywood and cinema chains Cineworld and Empire falling into administration. Well, on today's Sky News Daily podcast, Neil Patterson has been speaking with the chief executive of View International Cinemas, who told him he's hoping for a quick resolution to the strikes.
The actors' strike, SAG-AFTRA, it's different. I mean, that's been 40 years since their last strike and 60 years since both the writers and SAG-AFTRA were on strike together. It's been a long, long time, and the stakes are high. And we are hoping that because the stakes are so high, that there will be a quick resolution on it.
That's Tim Richards from View International, regular guest on this programme over the years. And if you want to hear that podcast, you can do so by scanning the QR code on your screen right now, and that will enable you to subscribe to the Sky News Daily wherever you get your podcasts, and that new episode will be in your feeds and on the Sky News app from 5 o'clock this afternoon, just 15 minutes from now. Still to come here on Business Live. We'll have a look at how the markets have finished up this Tuesday afternoon. Don't go away.
Fly Emirates, fly better.
Thank you.
Welcome back. A bit of breaking news to bring you. This is a statement that's just reached us from the Greek Air Force. It says 2 people have been killed in the Greek firefighting plane crash. Greek Air Force statement. We will have more on that at the top of the hour with Mark Austin. Well, the oil price has hit a level not seen since the 19th of April this afternoon as investors weigh up the prospect of further economic stimulus in China and what it means for the supply and demand equation. A barrel of Brent crude will currently cost you $83.39 a barrel. That is up 0.4%. Well, on the equity markets, European stocks have finished largely in mixed territory right now. The IBEX in Madrid, of course, still under a cloud following the uncertain Spanish election results on Sunday. The star performer in Europe this afternoon has been Logitech, the computer mouse and keyboard manufacturer from Switzerland. Its shares up by more than 11% in Zurich after it said sales and profits for the year would beat forecasts. Well, here in London, the FTSE 100 has finished in positive territory, up just over 1/6% higher, led by the mining heavyweights. Unilever has added 17 points to the index all by itself. It's finished up nearly 4.5%, as parts of its results statement were better than expected. Also among leading blue-chip gainers is the specialty chemicals group Croda, up nearly 4.75%. That's despite an 80% drop in half-year pre-tax profits that had already been signalled to the market. To the downside, Compass has finished nearly 5% lower. A trading update today from the world's biggest contract caterer is in line with expectations, but investors may have been looking for something a little bit better there. On Wall Street, well, there's been another strong opening. The S&P 500 and the Nasdaq are on course for their 5th consecutive monthly gains as we speak. Well, the Dow Jones Industrial Average, well, that is approaching levels seen last in February last year. Talking points this afternoon include the industrial giant GE. The shares there up 6.5% after its quarterly results beat expectations. On the foreign exchange markets, sterling up 0.25% against the dollar, up nearly 0.5% against the euro. Single currency, meanwhile, off by 1/7% against the dollar. Well, joining me this afternoon is Kevin Bosher. He's Chief Investment Officer at the investment group Ravenscroft. Kevin, good to see you this afternoon. I mean, obviously, we get the Fed decision tomorrow night, followed by the ECB on Thursday. But I note that there's a bit of a tug of war going on now in terms of how equity market investors view things. You know, there's a real divide between bulls and bears.
Absolutely, and good afternoon. Always a pleasure to have this opportunity. There very much is. I mean, on the bullish side is the fact that we are close to peak interest rates, whether that is this month or in 2 months' time. That the reality is in the US, certainly we're close to peak rates, and I think the markets are sort of anticipating the Fed turning and rates starting to come down next year. You have the fact that so far this year, the recession has been avoided and growth has held up much better than expected, largely thanks to strong consumption and employment markets. You've also got the reopening story in China. And of course, as well as all of that, equities, you know, benefiting from the fact that they've fallen materially over the past 18 months or so. So valuations across many markets and across many sectors look pretty good. Against that, and offset against that, obviously, are those bears that are concerned about the fact that inflation, whilst on the way down, is still way above the 2% central bank targets, and therefore the Fed and other central banks have more work to do. They believe that the recession has only so far been postponed, not avoided, and that the pain of recession is yet to come through. And in particular, I think they're focused on the negative impact that will have on earnings. So the debate continues, it grows. We have to remember that markets always like to climb that wall of worry. And I think for me, I'm in the optimistic camp beyond the next sort of 2 or 3 months, but I recognise that for the next few weeks, it's sensible to be cautious, given the fact that we don't yet know what the Fed are going to do, and they're still sounding pretty hawkish. The China reopening piece is good, but so far that recovery has been very disappointing. And of course, we continue to get escalation of some of the geopolitical concerns. So reasons for caution short term, but I'm an optimist that beyond that, I think we're moving into a better environment for asset markets, and that includes bonds as well as equities.
And just to stick with the equity piece for a moment, though, Kevin, what we've heard out of Wall Street, obviously we've been talking on this programme about the tech stocks, but we've had some very good results from the likes of GE this afternoon, General Motors too.
Yeah, no, absolutely. And I think so far earnings have held up much better than expected. Earnings and revenues generally have held up better than expected, not just in the US, in Europe as well. And I think there's a couple of reasons for that. Firstly, I think analysts had downgraded their expectations for earnings this year materially over the course of the last 12 months, and therefore the market had largely anticipated this. Secondly, of course, the fact we haven't yet seen a recession. Growth has held up much better than expected in Europe, the US, for lots of different reasons. And I think the third key point here that some people often miss is that in this cycle, we're in an inflationary environment. And in an inflationary environment, revenues, margins and profits for companies tend to hold up much better than in a deflationary or disinflationary environment, because companies, of course, are able to pass on those increased costs to the consumer.
Kevin, sorry, we've got to leave it there. Good to see you again this afternoon. Thank you. That's it from me. Back tomorrow at 11:30. Hope to see you then. Do stay tuned. Mark Oftin's up next. Cheerio.
The 5 of us have made it out of the car.
Welcome to Backstage, the film and TV podcast.